Ashraf, one of the biggest frustrations that business owners have is their business license gets approved, everything's set up, and then the bank rejects them. Why does this happen so much?
Because banking does not start after setup. It starts at the ownership and the structure of the company. And that part most people don't see. See, basically, the company can be legally formed and still the company completely unready for banking process.
And can you explain a little more about what you mean by unready? If the business is licensed, shouldn't that be enough?
The answer, unfortunately, the answer is no. The license confirms the company is existing, but the bank is not reviewing existence of business. The bank is reviewing risk, and this exactly completely a different process. Banks will look at the structure, ownership, activity, and how the clarity of source of funds and whether the business is actually making a commercial sense or not. If all these elements are not aligned, rejection is not surprising. Should be expected.
So what are banks really looking for then when they approve a company?
To give a proper answer of this question, we need to switch position with the bank. So basically, the bank is looking to the full picture of the company, means the ownership, how the money is generated and from where the source of funds are coming, and if the business will generate revenue aligned to that business activity, and if everything that they present to the bank is consistent across the document. If everything is okay, then the bank account will be open. If it's not, then we should not surprise. Basically, when the bank open a bank account, they are also taking a risk along with the business. So if the structure and ownership and everything that we align to the business makes sense, then should be perfectly fine. If it's not, then the bank will not proceed.
And where do you usually see businesses go wrong within this process?
The point here, it normally goes wrong even before it reaches the bank. They choose the wrong structure or ownership. They don't define the activity or they define activity too broadly or incorrectly. They don't prepare a proper document. And sometimes there is no clear commercial logic behind the business setup. So everything looks fine on papers. In the beginning, everything looks fine and makes logic, right? But when in the bank reviews, basically the gaps is there and the risk is there. And in this case, the rejection is an option to the bank.
And a lot of people think it's about submitting the right documents. Is that really the issue?
Yes, documents matter, right? But documents reflect structure. And the structure here is ownership, is the background of the ownership. If they are corporate ownership, then from where they source the money? If they are, again, individual ownership, they need the source of funds, where they are based, proof of address. So many questions will come after this, right? So basically, when you choose how you're going to build your business, you need to look to every details from the time that you decide what business activity you will do, what is who's going to be the owner, who's going to be the manager, what is the source of funds, how you're going to prove to the bank that you are really making sense of the business that you are doing. Then you have no gap, no chance giving to the bank to reject your case, or else definitely they will do.